All right, good afternoon, everyone. We're in the right dead middle of center. It's August 9th. Very happy to have you here and joining me for another wonderful training today. So we got already one question asked for today, which is expanding and elaborating on some creative financing. What are some ways we can still help our clients and potential customers afford a home, purchase, and the given situation is that they are probably lower credit scores, but they still have the desire, and maybe they have the down payment, but they don't have the credit rating earned yet. So those are situations that we could still help, support, and share, and hopefully find a solution. So I think in today's day and age, when real estate is still very expensive, and although we still see more inventory, the financing seems to be the primary issue on getting the transaction to fruition. So one of the things I want to share with you is loan program types. Okay. So let's go ahead, and I'm going to bring up an email from Vera because she had a really good email that I might have thrown in the trash. Hold on one second. Okay. So there are some programs that I wanted to share with you, and a lot of these real lenders do have, and I'll speak towards types of lenders and programs. Okay. So for example, in your situation, Yoko, you have someone with lower credit. Okay. So there are programs available. Okay. There is something here for foreign nationals where they put 30% down. There are also other programs with 40% down for foreign nationals who have zero credit. If you put 40% down, and even if you're a US citizen, you could do this. You can go to East West Cafe Bank, and they have 40% down programs for people with zero credit. They just put in higher down payment. So someone with low credit scores could also find a program like this with those banks, but they're just going to have a larger down payment. Now there's VOE programs. This is an ARM, 5-year ARM program. Currently, they have a 7-year ARM that's offered at 5.625, and for 5 years, it's slightly lower. VOE stands for verification of employment and is based upon their income, not necessarily their tax return. So if their income supports it, and there's someone that's giving them a W-2 or a 1099 and signs off a verification, you can follow this program to give you slightly better rates than what's on the market. And again, this is quoted as of July. So August, I think rates came down a little bit. It might be a tiny bit more attractive, maybe a quarter to a 0.5% lower. There's another program called investment property, where there's no employment needed at all. And investment properties technically could be based upon its income potential. And I've done this myself. It's called DSCR. And that's a program that allows based upon its future rental value. Okay. So some creative financing, it falls mostly, and this is the email I wanted to share with you, a bunch of loan programs offered by this company. And I know a lot of other companies also provide non-QM creative financing programs. So what is it? Bank statements. Okay. You could borrow up to 90% loan to value with no mortgage insurance, no PMI, where you don't need to submit your tax return. You don't need to submit a P&L if you're self-employed. This is a bank statement route. This is geared towards such people like us, realtors, people like Uber drivers, people who are self-employed. Maybe they're running an art business at home, or they have some sort of online sales store that they're self-employed. So if you have people like this, they can do it based on their bank deposits. And when they're looking at this program for bank statement loan, they want to make sure and see, is your deposits greater than your expenses for your business, self-employed business. So they'll look at your 12 months or 24-month bank statement program, and we'll look at your total number of deposits, what kind of expenses you have continuously, and they can analyze and provide you up to 90% loan to value of whatever it is that it appraises for without PMI. That's not bad. Okay. So these are people who maybe are people who work on tips. Maybe they have good amount of large tip income, and they don't have that necessarily reported on a tax return. Okay. Now, there's another situation where you could take a 1099 program, which is for self.
Hello. Yes.
Hello. Yes. Who's talking? Okay. So if you have a 1099 program for self-employed borrowers, such as in this
are you calling from the last winners? Okay.
Okay. So we have a situation where you have 90% LTV, no mortgage insurance. You don't need your 1040 on your tax return. So you look at what's called your 1099. So any company like our company as well, we issue you a 1099 miscellaneous. They call it a 1099 and non-employee compensation nowadays, NEC. So your income is based upon that 1099, and all of your 1099s, divide that by 12. That is your monthly income. So if you have $100,000 of 1099 income altogether, you divide that by 12, you're looking at roughly a 80, I don't know, divided by 12, 100,000 divided by 12. So that's your gross income. So that's pretty cool too, to help us realtors and other 1099 people get financing on that without PMI. The DSCR program is what I talked to you. This is a rental program. So if you look at the subject properties cash flow, so I'll give you an example. Let's say we take any property on the MLS today. So I'll look at one of our active listings. And I'll just do something on the affordable range. So let's say we have someone who wants to buy this Adara Street in Montclair. Okay. Good looking home. It just reduced price, 20,000 a week ago. All right. So this is a newer structure. You have a property as a large 2,100 square feet in Montclair, only 679. You look at this newer construction condominium, which has a detached structure. So it's a condo, but yet it's completely detached. That's not bad. You're buying it for $321 a square foot. Now let's imagine Yoko has a client who wants to buy this property. Okay. So here's what we could do. And then let's say you want to go under the DSCR program, the rental property. Well, all I have to do is write an offer on this property based on its rental income. And so I could do this. If I want to do this program under DSCR, you're going to have a lender by the bank. The bank is going to send out one of their own what's called appraisers, who are also going to do what's called a rental estimate appraisal. They're going to see this location here in Montclair and tell you what a 4-bedroom, 2.5 bath, 2,100 square foot home should rent for on fair market value. Okay. And I don't know what it is. Technically speaking, I can do it myself and to see if we qualify. So if I were in this situation, I would take this address and then I would see what is the appraiser going to appraise this rental income for. So I'll run a lease analysis, just like a CMA, for any actives, pendings, and close for the city of Montclair. And I want properties that are 3+ beds. I want properties that have a living area of 1950 to 2350. That way I give myself a cushion, and I want to look at the map close to where I'm at Montclair. So I just type in the address like I just did. Search the area, boom, it's right here. And I want to pick my comps. So based on this section here, there's about 7 comps to choose from. I'll go ahead and take a look and see, on average, they are leasing for a variety of amounts, but I want to pick the closest comp. Okay, so to give me the best indication, this one doesn't have a lot of photos. This looked like a very comparable comp right here. They're getting $1.53 per square foot. It's active, it's just smaller. Okay, so I know it's about $1.53 a square foot, and this one is about $1.29. This is the same similar community too, $1.32. Very similar as well, $1.71. And this one is $1.39. So I got sufficient comps for me to go ahead and start pricing this out. So what am I going to do? I'm going to take the ones that are located right here as my comps. So I want this one. I want this one. And I want this one as my comps. They're the closest ones. If there's a newer structure here, I'll take a look at it maybe. And if it supports my story, maybe I'll use it. If it doesn't, I won't. Let me go back and define if I found anything newer that's worthy of a comp. For today's purposes, I'll go ahead and just leave this one in because it's a nicer, newer one, and this one as well. Okay, so based on this, I could easily just go ahead and just for stat purposes, I'll go ahead and look at the stats. So out of the comps we picked from the closed, they averaged $1.40 a square foot. And the active ones are averaging about $1.55 a square foot. So that gives me a range, okay? I'm gonna use a range of the rest estimate to be $1.40 to $1.55. And that's kind of enough for me to proceed in comping out that property that we just looked at. So going back into here, we looked at Montclair. This is a 2,100 square feet. So I'm going to do the math with you right now. So to do the math, I'm just going to bring up a calculator. And you guys can see, I'll start sharing the calculator screen really quickly. I said $1.40 to $1.55. Is that what I said? I'll just use $1.40 times 2,111 square feet. That gives me a rental estimate of $29.55 times $1.52 range times 21 to 3,208. So our range of rent is between $2,955 to $3,200. Okay. So if I take the average of that, that should be roughly very close to $3,100 a month. Okay. So in order to qualify for this program that I'm showing you in my DSCR program, you look at the cash flow. So the $3,100 per month is what you can use as your cash flow, expected cash flow. And so they'll give you, as long as your cash flow is neutral or positive, they can provide you a loan. In the DSCR program, wants about 25% down program. So we have a property that is asking $679,000. Okay. So let's just say $675,000 is our purchase price. Okay, I'm going to show you 675. Times that by their loan balance, which is going to be 75%. 506,000 is their, I want to show you guys, 506,000 is your loan amount. So we need the loan amount monthly payment to become less than $3,100 per month. Okay. And I can do that exercise with you if you want. It all depends on what's the financing rate that they qualify for. But if I'm looking at this, I can just tell you roughly to see if this makes sense. So using my handy dandy Carl's mortgage calculator, which I hope you can see, I'm putting it in at 6% interest. This is a loan amount of 75% down. They're going to put down 168, 25% down. The loan amount's 506. That makes a monthly payment of $3,035. Okay. That's actually now within the guidelines, they can issue you a loan, as long as the appraisal shows that it is like we just did. This exercise shows that it should have ran for $3,100 per month or more. This comp is probably better than the other comps. So there's a chance that this appraises for $3,200 to $3,300 per month. Okay, because it's newer than the comps that I used. So to me, this has the opportunity with 25% down to get the DSCR program, in which they don't check your tax returns. Okay, this is strictly based upon its future rental value, cash flow. Okay, so that's what this DSCR program. They have 4 national programs and ITIN programs. That's not to answer your question, Yoko, but I wanted to share with you that there's a 1-year full doc program. You can just show all of your financials and all your docs, and they might be able to get you a loan based on 80% of its loan to value. And there's another way to help your borrowers, which is less desirable because you're really spreading your payments out. You could do a 40-year conventional loan. And that brings your payments closer to what the borrowers are able to pay. 90% of people don't live out a 30-year term or a 40-year term. People don't stay in the properties that long. They typically transfer hands every 10.5 years, and or they refinance. So in these situations, maybe this is just to help them afford it, to get into the property. Why not just get the 40 years now? You can always refinance in a year, 2 years down the line. So that's another creative way to help get deals done for customers who are unable to really obtain the financings or don't have the tax returns. Now, Yoko's specific question is for credit. Let's say I have a borrower who has decent income, they have low credit scores, but they still want to try to buy a home. So in those situations, let's say you want to buy this home, okay? Well, there's one way I want to remind all of you is that there's CALHFA forgivable loans, okay? So the income has to be, anyway, I explained this before in a past class, so I won't go into too much detail, but all that I'm telling you is that the client in this situation would, as long as their income is probably less than 90 something thousand dollars, which a lot of people are in this bubble, you would be able to purchase with 10% down, $67,000 roughly, and have this home as long as you get a first, which is an 80% loan, conventional, or a CALHFA, and then you get a second loan that's forgivable for the remaining 10%. Okay, so it's really good program for first-time home buyers. They must own it as a primary residence. The income limits are very generous. So a lot of people do qualify is based on the county, and you can just type it in this link and see what is the income limits that for that city. And all of that is going to be forgiven. The 10% part will be forgiven. Okay, so I like this as a route to use, but you have to use a preferred loan officer that understands the forgivable equity builder loan sponsored by state CALHFA financing. Okay, they will give you the first and the second. Okay, so you do have to be eligible through these requirements here, and it's income limits. It doesn't say anything about FICO scores as being your eligibility, but I'm sure they need to make sure you have some form of reported income. Okay, now that's another solution to you, Yoko, to introduce them to this program. Speak with a lender of that's knowledgeable, whether they are qualified or not, and read up on it. It's very, very easy. They just take a course and sit in on a 6-hour education class, I think it is. And you can do it online too. 8-hour home class. Okay. So that's another program. The last thing I'm going to talk to you is one of the direct solution. So Yoko was asking, is there any creative ways to get the seller involved in this potential purchase? And absolutely, when you're negotiating for a buyer, everything is negotiable, if even the financing. Okay, so here's what you do. Number one, you look for a property that is days on market greater than 25 days on market. Why? Because if it's new listing, most sellers don't want to offer financing. But if you want to get a deal done, the sellers that are willing to are probably the ones that are not sold yet. They still haven't gotten their price. They still haven't gotten any activity or offers that they're interested in. So maybe you are the one sole buyer that will give them the offer they like. And then you just got to structure some terms. The terms of the financing could be very simple. So you look for something that's sitting on the market greater than 25 days. Then you look at a property that has equity. Okay. How do I find that out, Kelvin? Simple. You go to the property and see how much is their financing amount. Okay. Because if this seller has some sort of 90 or 95% borrowed money and they don't have much equity after the closing costs, they don't have much to finance at all. So in this situation, I look at the sales price of when it was purchased. And in this situation, we don't have the mortgage information because this is probably financed through the builder in 2018 when it was purchased. So let me give you another example how to find financing. Because this, you can always call the listing agent. How much equity does it have property have? If you don't know, if in this situation, just call the listing agent to find out how much is their payoff. So that way you can see if this works out for you or not. Now let's take another property then. I'll just go to the next one right here. Now this property here is also newer, but let's see if the financing is displayed for our public view. And I can look in here. Yes, there is public data. This property closed in 2017. They purchased $487,000, borrowing $340,800. And at some point in time, 2019 to 2020, this property by grant deed has transferred hands, and the current owner is Hongguo Wang, okay? And this person financed in 2020, 372,000, right? I subtract in 2020, this is the mortgage amount, so they probably owe something a little bit less than this, maybe 360s, okay? Because it's only been 1 or 2 years that they've been paying it off. And so if they have about 360s owed, then I look at the purchase price. This purchase price is 728. This is a great candidate for seller financing. Why? Because they have almost 50% equity. 360 to 728. Yeah, there's more than 50% equity here. So in this situation, all you need to do is you write an offer, you put in and do what's called the most that your borrower can qualify for a first loan. Okay, someone with low credit or someone who doesn't have they have a job but they have low credit, they can still try to get up. Let's say this property appraises for 720. Okay, maybe a conservative bank based upon their income is only willing to offer them maybe, you know, a $500,000 or $400,000 loan. Okay, then they get a first for the 450,000. I just take right in the middle. They put in their own maybe 10% down, which is going to be 72,000. And the rest, the remaining balance, will be seller financed. And so the difference of 450 plus 72 down, which is at only 10%, becomes a 525. You subtract that from let's say your offer is 725. Okay, the seller finances you $200,000. Okay, and that could be at 4%, 5%, 10%. It could be at whatever interest rate that is negotiated. It doesn't even have to have an interest rate. Maybe the seller just really wants to get 725,000. That they insist on this. I don't care about your interest. Just pay me my balance of $200,000 at the end of 3 years when you make your money, or you refinance your property in 3 years, whatever it is. Pay me my 200,000, and I don't need any interest. Just give me 200,000 in full. Okay, that's called a balloon payment with 0 interest. You can structure that out. Okay, and you've created a situation that's win-win. Your buyer got the property. They got maybe a 0, 1, or very attractive interest rate that's better than the bank rates at 6% today. You can structure it at 2, 3%. That's still a win for your buyer. You could ultimately you're also hitting the seller's minimum goal of 725. They're getting that payment. They're getting their loan paid off. They have the sale completed in 2021 where no longer is that mortgage and the vacant property working against their equity. So that bleeding stopped for the seller. And then you have a buyer coming in who's going to pay them the difference of whatever the amount they borrowed and whatever you structured out in 3 years, 5 years, 7 years, whatever you want to, whatever term you want to put in there. It could be balloon payment. It could be graduated payments. It could be a fixed payment. It could be interest only. You could structure creatively however you want to structure the financing out with this seller. If this seller had no note, no mortgage, you could finance 100% from the seller. And some sellers who are either very motivated, who want to stop the bleeding, who want to achieve their asking price, but they don't mind that they finance some of this to the buyer, because at the end of the day, if the buyer failed to pay off the $200,000 by the end of the term, this seller still gets to foreclose on this property. And they still have equity because we would anticipate in 3-5 years, markets return back to normal. There's still going to be enough equity to pay them back through foreclosure. So there's not much risk at all. It's just a matter of explaining and being able to get their buy-in. So you just have to be familiar in how to explain this out to both sides, the buyer and the seller. Okay.
Kelvin, I have a question.
Yes.
So in that case, whoever the seller is, she's supposed to involve the mortgage officer to do that, so, or to write a note, that kind of things. Do I need to ask the escrow officer or mortgage officer to do that?
Great question. So follow me along in my CAR forms, and hopefully you'll see me pop into my zip forms, and I'll show you what to do. So if you're structuring and you already have what's called seller financing available, like some listing agents are smart. They know that they can't get any offers through. So what do? They expand their listing to accommodate, because a lot of listings are sitting on the market. Okay. So let me show you what you could do. Let me talk and see. I have a buyer situation. They have very low what's called very low FICO scores. So the traditional lenders are going to shy away from someone who has less than 600 FICO scores. Absolutely. I understand that. Yes. Now, all you have to do is go to your MLS, and you could do it like this. Look for owner may carry, owner may pay points, private financing available, yeah, look for these, okay? And these terms will show you, and I just do this, the cities, let's say Los Angeles County. I don't want all of the entire state. So I got 59 properties to sell my buyer on, where the seller is open to financing. Okay, so here it is. We take a look, and then I'll just go ahead. And again, just because it's in here does not mean it's 100%, because some listing agents will check those boxes and they don't even know what they checked. Some agents are not understanding what they've done. So here's a single family in West Covina, and they are open to what's called finance. So let's go ahead and take a look at this 750,000. You got a nice single family. A lot of buyers who are low credit would love to have this home. Okay, so what could we do? Well, let's talk about and see what is going on this transaction. The listing agent here has declared that they are looking for conventional loans, the options to lease this property, owner are willing to carry, and they're all open to giving private financing. All you got to do is contact Josie for questions, offers. If you have clients that cannot qualify for bank financing, but they have income and down payment, we can help them with home ownership. So the price is a straight sale, cash sale with our own financing, and rent to own. Price is higher, MLS entry only, blah, 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 blah. And they are willing to entertain your client. Probably they're saying that if you are going to finance with the seller, they might ask for a higher price. Again, everything is negotiable, because you have an agent here who is going to negotiate for the seller, and I'm going to negotiate for the buyer. So sure, that's what I'm here for. That's my duty. I'm an agent. I'm supposed to negotiate. So yeah, I'd be willing to try to negotiate. Maybe I don't have to increase the price, or maybe I'm willing to give the price, but I want better. Like, I don't mind. This property is unsold for 12 days. They want 750. I don't mind paying them 760 if my interest rate is only 1%. Does that make sense? I don't mind paying them 800,000 if I'm getting a 0% financing rate, interest rate. Okay. So everything is all relative to how you structure it out. And if you ask me, Kelvin, why would you want to pay 800,000? Because in the course of 30 years, I'm going to pull up my calculator for you. This is a 750 property, right? $750,000. I'm going to show you what I'm doing. If I put down 20% down, I'm borrowing 600,000 at 6% financing. My interest payment over the course of 30 years loan, I am paying a total of my interest. And hold on. This is 20% down, monthly payments. In 30 years, I will have made a payment of $35.97 every month for 30 years. My loan expires in 2051. The total amount of payments I made for this 30-year loan is $1,295,000. That means out of this payment of $1,295,000, almost $700,000 of this is worth of his interest. So if I can get a seller to give me 1% interest or 2% interest, it's absolutely okay to give them a price of $800,000, because in the net grand scheme of things, I would be paying less overall for the next 30 years with the higher price, low interest. Does that make sense? So let's say I structure this out. Let's say my client loves it. They want to give them a full price offer, but we need financing, but we have maybe 15% down. Okay. What do I do, Kelvin? Well, let's go into the structuring this out. I'm not going to show you how to write the offer. I'm going to show you what we're going to do to add to the offer and supplement. So I got a property here that I'm working on, and this property on whatever the transaction name, it doesn't really matter. I add a document called SFA. And I'm going to show you what a purchase agreement is going to look like too. So first thing we're going to do, you guys see my zip forms right now, contract? Yes or no?
Yes.
All right. Imagine this is the right property, the right address, everything here is filled out. You're going to write in a $750,000 property, close of escrow in, let's say, 35 days or 30 days. Initial deposit is going to be 3%. So that's going to be, let's just say $20,000 and $25,000. Okay, somewhere in the middle. And you're going to go ahead and do loan amount. Okay, so in this situation, I mean, it's all negotiable, whether you're going to do a first with your own bank, or let's say you do seller finance with the whole amount. So in this situation, we're going to check the box seller financing. We're going to ask for the seller to finance 80% of this loan, 750,000 times 80% is 600,000. Because I'm not going to because I have a low credit score, I'm very likely not to get any great rates with the banks out there. So I'm willing to pay not up to exceed, let's say up to 6%, or fixed or adjustable rate, not to exceed 6%, blah, 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 blah. Seller financing is checked here. And then I would probably go ahead let me just go ahead and I'm going to put you can structure it as a first and a second, or just a first for the seller. So let's just structure it as a first for the seller, a first trust deed. Okay. And I would just probably say CSFA attached. Okay. And go ahead and finance. I think they want you to put it under here. I think for seller financing, they want you to put it here. Okay. So this is gonna be my primary residence. So this buyer is gonna have to put in down 127 plus 23, which is 150,000. The purchase price is the asking price, and the seller is gonna finance me 600,000 according to the seller financing addendum. And then I'm gonna go ahead and show you that we just click on our box here for the seller financing addendum. Go back into our forms. Pick up the seller financing addendum, in which we read and share that this property, the principal amount is 600,000. And we're gonna maybe just do, let's just say we've got 5% interest per year at approximately, and you can base it upon annual or yearly payments or blah, 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 blah. You can structure this out, okay? So in this situation, you can just say you want, it all depends on your term. So let's just say you're gonna stretch this out to 7 years, okay? So if I'm gonna do a straight note, I'd have to calculate this out using one of my calculators. And at 5% interest over the years of 7 years, a straight note's going to be expensive. It's 8480.35 per month. Okay. That's because you're spreading it out in 7 years instead of 30 years. So this seller will be getting an 8480 monthly payment every month. And you're going to fill out, you can leave this part blank. Credit documents would be a note and deed of trust. Okay. And you can charge late fees if you like, and it can is late after 5 days of, let's say, $100, $80 late fee. Okay. You can have
So, Carolyn, so those terms are really up to the seller, the late charge, like a percentage or date. There's no like.
No, it's not up to the seller. It's up to the parties. It's
Okay,
negotiable.
I see. Got it.
But yeah, the seller definitely needs to be involved because this is called seller financing. So they have to be in agreement. And you could propose, let's say you propose 2%, and the seller says, well, yeah, you give me full price, but no, I want 5%. Fine. I mean, that's better than the banks anyways. So this is a way to make it work for the parties. The seller might get their full price that they want, and they just giving financing at 5%. That's better than what they would be doing if they parked it at the bank. Okay. So that's a situation where you could do this, but no, it's not just, this is not a thing that just dictates by one party. This is negotiable. Okay. Now, if you stretch this out over a longer period of duration, this payment gets lower by a lot. Okay. The good thing, positives, you have no lender involved. You have no technical appraiser involved. So you have no technically anything prohibiting you from this sale at all. It's just the buyer has to be happy with the condition. Secondly, there's no credit reports even needed, even though as a seller's listing agent, I would probably ask for a credit report. Yeah, I want to know who I'm financing to. But I'm not here to negotiate for the seller. I'm helping the buyer only right now. Listen, we're imagining the seller is someone else's client. There's no lender fee. You have no fees involved if you structure it like this. So that's more money in the pie for both the parties. You also don't have any points technically, unless you want to build some points into the program. But normally in seller financing, there's really no points. Okay. And
Kelvin,
Yeah,
Yeah, this is Jean. So since if we already have the first trustee from the bank, so the seller then will be the second trustee.
yep.
So
Yeah.
so when the lender saw that, don't you think it's easy to get approved? You have the second trustee.
Well, lender is in first position, so they're, as long as they're lending on conventional guidelines like 80% conventional, there's nothing wrong with the seller offering 10% second position in escrow, and you just get involved with the escrow officer and the other party. That maybe you can record the second note the day after closing.
What do you mean the second note? And because on the purchase contract, we already put down seller, it will be carry the rest of the balance, right?
Mhm.
Of the amount, and should be recorded at the same closing day on the government's
So-
record.
So the traditional bank, they're gonna record escrow and close, and you're gonna have an addendum signed by both parties, and you're gonna have an executed notarized all-inclusive trustee or some sort of straight note. And that, I'm telling you, is if you feel that the first position lender does not want to see the second, you record it the day after close of escrow.
Oh, I see. And but although after close escrow, we do the recording as a second trustee, and but when the buyer after a couple year later, and then they don't want to pay the mortgage, so the lender will be the only one take
Then the
over
first
property.
position, the first position will get probably their full amount due, because that's the chain of payout is IRS, government judgments, and all these government liens. They all are highest priority. Then it goes to the first position bank, and then it goes to the second, then it goes to a third, fourth, fifth, and junior liens, mechanic liens, or whoever, whatever other else types of you have to follow the chain of command. But yeah, the
Yeah,
first
so-
position gets paid first, and the
Yeah.
seller who's in second position in this instance could be not getting their full amount back. Yeah.
Yeah, that's the risk if the market is dropped. So that will be the risk for the seller.
Yep. And I don't
Mhm.
advise the seller of the risk, because in this example, I'm not representing the seller.
Mm-hmm. Yeah, got you. Okay. Yeah, I just want to clarify, like the payout in case the buyer doesn't want to continue the mortgage. So yeah, just see how is the procedure. The
Yeah.
people can get the money. Yeah.
This is a
Okay.
way you can get this money. Is all you need is one seller to say and agree to get this payment over spread out for the time or provide financing. And I've already shown you, just in the city of LA County, going back at the views, we have 59 willing sellers that openly and asking to please just give me an offer, give me some activity, give me something to work with. So you have 59 people willing to play ball to help a client who may have low credit scores. Again, I have a different story. The longer it's on days on market, the more willing they are, I bet you. Okay.
Okay,
So,
thank you.
So again, you don't even have to give them full price. I'm just saying, sometimes it actually makes sense. You can give them over asking, as long as if I get very low interest rate, it actually works out better for me in the end. So it's just, this is how you can kind of cater it to the payment system, because that's how car dealers who are salespeople, they don't like to talk to you about the price. They want to look at your payments. What can you afford? What are you willing to pay for your lease or for your vehicle? And then we'll structure the financing around your payment that you want to pay. Okay. So that's why I told you, you want a payment of $3,000 a month? Okay, we can do it. But you don't have 20% down? Oh, you have 15% down? Okay, we'll do 50% down your payment is 3,000 a month. I'll just do a 40-year conventional, and boom, it meets their needs just by going and adding the years, because the interest is way greater when it's 40 years. Right? I already demonstrated to you that
Yeah.
if you, this exact property, you're paying in the course of 30 years with a 20% down, this 600,000 loan amount, you are paying a total of, oh, hold on, this has changed. It was roughly okay, hold on. Let me just do this over 30 years again. At a 6% interest rate, you're paying a total interest of 695,000. It's almost 700,000, the entire purchase price over the course of 30 years. So again, that's why I said a lot of people don't survive their full 30-year term. Make sense?
Yes.
Yoko, does that answer your question?
Yes, thank you very much. This was very helpful.
Okay.
I can see that the big picture now. Thank you.
So you look for those properties, especially the ones sitting on the market. Now, again, just because my search criteria included these terms, there are many more sellers who are willing to carry that are not labeled under this section under listing terms, because the listing agent doesn't know what to do. So I'm going to tell you, there's a lot of listing agents, and I bet you most of you in here did not know how to find this, right? And you guys are experienced. So I'm telling you, there's just because I told you there's 59, there's probably hundreds or thousands of listings that you could potentially pick up the phone and call the listing agent who's sitting on the market for 60, 90 days, and they know that their listing is expiring in one more month, right? If I don't work something out, I don't get my commission. Yes, seller, I'll talk to the seller about financing. How much do you have down? Put it in writing, put it in an offer. Let me review it. But I'm definitely open to sharing and hopefully I'll persuade it to the seller, because quite frankly, I don't have anything. These listing agents are gonna want you to send them an offer, because otherwise they get nothing. So use this leverage to your advantage. Talk to the listing agent, see who's willing to play ball with seller financing for some amount, like 10, 20%, or larger in a situation, depending on whether your buyer wants to go through a first traditional bank or whether they want to get it all done through the seller. Okay. Who does this work for? It depends on your timing. So if you are doing a short-term borrow, like 5 years or less, it appeals to anyone who just wants to get their price. But if you're trying to stretch a 30-year payment on a seller that's 80 years old, it's not going to appeal to them. They want their money now. Okay.
Yep. Okay.
Okay. Now, that's creative financing for you guys. Besides this seller who where to find them, and I showed you where to go, you can always pick up the phone and call the listing agents, number one. Number two is introduce the CALHFA program. Number three is you can do a blend. So you take and borrow whatever the maximum their bank is willing to offer them, and then you just supplement it with just a small 80,000 financing or $100,000 financing. I've seen this all the time. A lot of times how do I see this seller financing addendum? Well, oftentimes you can even bring it into play when you're trying to negotiate. So sometimes you have a seller saying, I'm not going to reduce my price. Oh, I don't want to give you any credits for the foundation or the roof that I know is old. Okay. Well, how about this? Let's meet in the middle. Okay. I want to drop the price and negotiate 50,000 off. You want to hold on to the original contracted price. So why don't we just go ahead and reduce the price in the middle to 725, and I'll give you 25,000 and I'll meet you in the middle, and then I'll just strike it as an addendum that I'll pay you after close of escrow in 3 years of balloon payment, $25,000. So there's some ways to structure this. where I still give the seller the net they want. And then I can even drop the price down, but give the seller better favorable terms on the note or structure it out that way. It's confusing how because I can't really explain every scenario. It just needs a willing ear. If you have a willing ear, someone willing to entertain, and then how do I do it? I usually a great way as an agent, as a buyer's agent, I'll give them two options. I'll give you one option with high interest for the seller, lower price, and then another option with the lower price for my terms, but I give them better rates on the note. And then let them pick. Because some seniors actually would like to have monthly income passively over the next 7 years. And they don't want to be investing or repurchasing another property. So they're okay obtaining a monthly income from your client because it helps them with their living expenses. Okay. And these are the people who own these properties. They're the seniors out there. They're older people, baby boomers. They're approaching retirement. So having that is a way to spin it in the right way. Okay. It's all how you present the information. And so when I present people with options, it kind of shows that I'm cooperative. Well, here's a great price, but lower interest. Here's a lower price, but great interest for you for the next 5 years. Would you like to live off this retirement income? You know, here, boom, pick your poison. Okay. So that's what it is. You know, it just takes a little bit of persuasion, takes a little bit of effort. And at the same time, you're putting a deal together with the listing agent who might be expiring or losing their listing soon. So those are the ones that are going to be hopefully trying to get any offer and work with anyone, because after your 30 days, 60 days on the market, it's hard for these listing agents to get them sold. And a lot of them are very tired of doing open house every weekend with very little activity. So you're doing them a favor by presenting them some options, but your buyer has low credit. Okay. Anything else to cover today? Anyone else have any questions?
Good. Thank you.
Okay, you're welcome. Thanks for joining us.
Kevin.
Yeah, Randy, how can I help you?
Hey, Kevin, where are you? Are you by the beach?
Next week. I'm in my Temple City office right now.
Oh, I see.
Preparing to go to Hawaii. I'm leaving August 20th. So in 11 days. So I will be in Hawaii for 1 week.
Okay. All right. Thank you very much.
You're welcome. I hope you guys got some value out of today's class. Again, just thinking outside the box, because I like Yoko's question. Creative financing for low income or for people with bad credit. There are solutions, and all the lenders typically have a lot of the stuff that I showed to you at the beginning. They have those programs, but you can't solve a broken, you can't get a broken will to run. So if their credit is really that damaged, they have a bankruptcy on their file, they're not going to get credit. So you can't fix something that can't be fixed yet. So in some certain situations, if they're bankrupt and they filed recently in the last 7 years, they're not going to qualify for any financing. Okay, any form of those bankruptcies. So if their credit is impacted from some negative reporting that they didn't realize, then you should take them to a credit repair. And I'll give you someone, Yoko. There's a credit repair person that could bring them up 100, 200 points just like that, simply by paying off a $30 charge they found missing over, and that has become interest to like $2,000. So
Can I get the information?
yes, I'll give it to you.
Thank you.
It's called Journey. I'll share it with you, Yoko. I'll email it to you. So I sent one customer to this company, and then they are successful at bringing people, giving them advice on, and then helping them understand and put together the paperwork to get their credit score. Adrian, this is his name. Okay. Any other questions?
No,
All
No,
right, guys.
thank you.
So
thank you.
you're welcome, guys. Thanks for being here today. I appreciate you guys all staying
Thank
till the
you.
very end. Make it a great week. Enjoy the weekend and let me know if you need anything.
Bye.
Yeah, bye.